Part 2. In this video, I'm going to go over the frequently asked questions for qualified opportunity funds and qualified opportunity zones. Let's go. Hey guys, before we get started, please smash the like button and follow if you're new to the channel. So for example, say you sold Apple stock and you had $100,000 worth of taxes owed. If you invest all of your money into that investment, qualified opportunity fund, which is in a qualified opportunity zone. In this example here, let's say you did have $100,000 of tax that you would owe. Not only did you get a reduction of $15,000, that's a savings on tax that you would have had to pay. But in addition to that, you get to actually avoid paying the $100,000 in tax, and you get to borrow the money and put it into this new investment. Basically, the money you would have owed to the IRS at the end of the year is pushed back. You then get to use it into this new investment, and you get to gain appreciation on this basically borrowed money. So your return, your ROI on the deal is usually better. So keep in mind, you're basically borrowing money that you owe for taxes for free. So what's really awesome about the second part is, let's just say you have $500,000 invested. And after 10 years, it becomes $2 million. So there's a $1.5 million profit. Because you've held the money in the deal for 10 years, you have a step up in basis. So step up in basis means this. A basis means your initial investment, basically. So if you bought a property for $500,000 and you paid for it cash, your basis is $500,000. Now, after 10 years, let's just say you paid $500,000 in cash, it's worth $2 million. When you sell the property, the IRS will say, okay, you sold it for $2 million minus $500K, you owe $1.5 million, or you profited $1.5 million, so you owe capital gains on that $1.5 million. Now, if you have a step up in basis, the IRS will say, well, it's as if you didn't spend $500,000, it's as if you spent $2 million. So what they'll do is they'll take $2 million, which is what you sold it for, they'll make your basis $2 million, so your tax due or taxable profit is zero. So then when they say, okay, your profit is 0 times tax rate equals 0, right? That is what's awesome about this. Qualified Opportunity Fund buys, builds properties and businesses within a qualified opportunity zone. You could build a business with no real estate within a qualified opportunity zone, or you can choose to build real estate within a qualified opportunity zone. How do I elect to defer an eligible gain? On your tax return, when you're electing to defer an eligible gain, for example, if you have a sale of a stock, you sold Apple stock or you sold Bitcoin, and you have a significant gain, earlier I mentioned how you can choose to put that money into a qualified opportunity fund, and you would avoid paying the tax now. You are deferring the tax. If you hold it in the fund for 5 years, it's a 10% reduction. If you hold it in the fund for 7 years, it's a 15% reduction. You would make your election on Form 8949. The next question we get is, can a non-resident alien or a foreign corporation invest in a qualified opportunity fund? The answer is yes, they can. They are eligible for the tax incentives as well. Regarding a qualified opportunity fund, there are some things that you need to remember. So first, with a qualified opportunity fund, when it's raising money, let's just say it raises $1 million. From the date it raises its money, there's a rule. You have 12 months to deploy the money. So you have 12 months to acquire, in the example of a piece of real estate, you have 12 months to spend $1 million to buy a piece of real estate. Now you bought this piece of real estate and you spent $1 million. You have, from that point in time, from the time you acquire the funds, you have 31 months. So you have 31 months to invest an additional $1 million into the property to qualify your fund. So you're not just buying real estate, you must also substantially improve it. So there's a substantial improvement test, which is, again, you must spend at least the amount of money you purchased the property for in the property's investment. In addition to that, there's a rule of having a substantial amount of business in your qualified opportunity zone. In the sense of a piece of real estate, it's easy because your building's not going anywhere, so everything's within the fund, within the zone. Now, if your qualified opportunity fund purchased, for example, a dry cleaner or built a dry cleaner, it would say build out this dry cleaner and you have this really awesome dry cleaner. It's making a lot of money. The rules regarding the business within a qualified opportunity fund that's in a qualified opportunity zone is that 90% of the business's income and assets and everything needs to stay within the zone. So a simple way to do that is to make sure that if you have more than one dry cleaners, that you have them as separate entities, that they are separate from each other. But if you have the same qualified opportunity fund, the same company own more than one dry cleaners, and like I mentioned, they're on different sides of the road, but this side of the road is an eligible zone and this is not, now you just invalidated your fund. So be very careful that if you have a business, that you make sure that 90% of the income is from the business that's within the zone. And part two is that if you have a real estate, you make sure you do the substantial improvement to keep your fund qualified. And remember the time. You have 12 months to spend the money. From the fund's creation and receiving of the money, you have 31 months to have the substantial improvement done. So if you want more content, smash the like button and subscribe to the channel. A lot more content coming. We post at least once a week with lots of great financial information to help you build your personal portfolio.